Hey everybody, Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania with this week's Rotella QCast update. What am I talking about today? It's a follow-up to one of the videos I did a couple of months ago, why you don't want to have a savings account at a bank. Now, I don't want to sound too controversial here, but there's some very important reasons why you don't want to have a savings account at a bank. You've got to understand that when people hear savings accounts at the bank, and this goes back literally 75 years, people would open a checking account. The bank would say, hey, how about opening a savings account? And people will hear the word savings and they're thinking, wow, that means I'm saving money. You are not saving money, especially in this day and age. Right now, banks are flush with cash. They have a tremendous amount in deposits and on their balance sheets as well. So whenever banks have a lot of money, they literally don't pay you any interest, or they pay you a very low amount of interest. So if you have money in a savings account, if you have more than $10,000 in a savings account, you are literally giving away about $100 a year to the bank, and that's where they're making all the money. So again, you hear the word savings account, that doesn't mean you're saving money. That means you are making money for the bank because they're not paying you any interest on those deposits. So what do you end up doing? What we do in our practice here, or what we suggest people do in general, is that you have just a checking account that you pay all your bills in. You have all your money deposited in the checking account. So for example, if you're working, you would have your paycheck deposited directly into the checking account, have your checking account hooked up to your credit cards so that they can automatically be debited from your checking account. But what you need to do is open an investment account. Many of the major custodians, Fidelity, Schwab, TD Ameritrade, Vanguard, have investment accounts. You either open an investment account in your name, or if you're married, you open it in joint name with your wife. You then tie that checking account to that investment account. And what ends up happening, for example, in our practice, is that when people build up too much money in their checking account, they call us up and they say, hey, Chris, can you transfer over 5,000, 10,000, whatever the case may be, into their investment account? And it's vice versa. We have conversations with clients all the time where they say, hey, listen, just leave 2,000 or 3,000 in the investment account, totally liquid, and we can transfer that in one day. Even if you have investments in your investment account, they can be sold and the money can be sent to your checking account literally in one day. So why would you have your money in a savings account paying you 0% interest? Well, the second question that people ask me all the time is, well, gee, Chris, what do we invest in this investment account where we want to have access to our money, but we kind of want it safe? So typically what we do in our practice is we tend to have more equity-oriented investments in people's 401ks and their IRAs, because that way if you make gains in those retirement accounts, you're not taxed on them. Typically in the investment account that we're using, we tend to put safer investments in that because that's your safer money. And again, if you've been watching my videos, one of the things we talk about is how much do you have in the different risk buckets out there. And you may have a risk bucket in your investment account where you're saying, hey, listen, I want to have this money at a lower risk investment. You can see here is that all the major custodians have access to CDs, taxable bonds, tax-free bonds, etc. This is a screen that I pull up every morning to see where rates are and as far as what I can do with clients' safe or short-term investable cash. You can see that we happen to custody at TD Ameritrade. Right now, CDs 0 to 1 year are paying 1.25%. So again, if a savings account is paying you 0, you can literally make 1.25%. So on a $10,000 account, you can go from making nothing to at least $125 with a bank CD. Interestingly enough, at the major custodians, if you have a bank CD, what people don't realize is that you can buy and sell bank CDs. You do not have to hold them for maturity. And you don't have a penalty if you sell your bank CD. You just get whatever the going rate is as far as the market goes. Now, we're beginning to get interested in bank CDs again because obviously the rates are coming up over 1%. You can see at 1 to 3 year CD about 2.5%. But the other thing I do is if I know people have cash they're not touching, I look for used bank CDs. These are CDs that are put out on the secondary market where somebody had to get rid of them and sell them because they needed money for taxes, a car, whatever. Well, many times you can get an extra quarter to even a 0.5% higher interest rate from these used bank CDs. So we're beginning to look at that. But I've circled some other areas here that you really have to focus on because, again, if you've been watching my videos, Last week's videos that we did previously was talking about the bond market and how interest rates have gone up. And you can see I've circled tax-free muni bonds right now. 1 to 3 years are paying 3%. You can see 5 to 7 years are paying 3.65%, and you're getting almost 4% tax-free going out into a tax-free bond for 10 years. This is a lot of value. It's value we haven't seen in the tax-free bond market literally in 10 years. So one of the things we're doing is we're increasing clients' duration, which means we're moving out into longer bonds because they're offering a lot of value. You can also see it in the upper right-hand corner. We're looking at agencies or mortgage-backed bonds as well, because those are yielding over 4%. So again, there are a lot of alternatives to parking your money in a savings account where you're literally making 0%. So to sum it up, you should not have a savings account, or what I like to say, it's a don't pay me any interest account is what a savings account really is. So break the chain of having your money in a savings account, open an investment account, hook it up to your checking account, and start to earn more interest. That's all we have for this week. Thanks much. We'll be back next week.